What is a stock exchange? Once a company goes public, its stocks can be traded freely on the stock market. This means that investors can buy and sell shares among themselves. This is the secondary market for stocks, and most trading is done through stock exchanges. This part of the larger stock market dates to at least 1602 in Amsterdam, evolving since into some of the world's most complex institutions. Stock exchanges are organized and regulated places. Much trading today is virtual, where stocks and other types of securities are bought and sold. They play a crucial role in the financial system by providing a platform for companies to raise money by selling their stocks and bonds to the public. The NYSE and NASDAQ are prime examples, serving as central locations for the buying and selling of stocks. There are major exchanges worldwide, such as the London Stock Exchange, the Tokyo Stock Exchange, and the Shanghai Stock Exchange. Each has its own internal rules, and investors follow different national and local laws. These are meant to ensure fair trading practices and to keep investors confident in dealing there. They also provide transparency in the trading process, giving real-time information on securities prices, which is why it's so easy to find up-to-date stock prices on just about any financial news site. Stock exchanges wouldn't live up to their name, though, if they didn't offer liquidity, the ability to buy or sell stocks relatively easily. This means that during trading hours, you can buy a stock quickly or just as rapidly sell it to raise cash. Many stock exchanges also cross-list company shares, offering securities primarily listed on other exchanges. This way, companies can reach more investors when raising capital, and those trading with certain exchanges have far more options.